Thanks for joining us at XM.com. This is The Week Ahead. I'm Cristina Marujos, and with me today is our lead investment analyst, Rafi Boyadjian. Rafi, it's going to be a data-packed week. Let's start with the United States. It will be a very interesting week for the US dollar. CPI inflation data for January is out on Tuesday, along with a host of other releases next week. Therefore, how could the data reshape market expectations regarding the first Fed rate cut?
Well, Christina, as you said, it is the CPI report time all over again. And of course, this is going to be the main focus because it comes hot on the heels of that very strong jobs report, which was followed by an equally strong ISM services PMI. So we've seen investors price out round about 2 rate cuts from the expected rate cuts for the Fed for this year. So we could see some volatility should we get any surprises. Now, as far as the inflation outlook is concerned, we have been hearing from the Fed that they are not quite there yet in terms of seeing convincing signs that inflation is on a sustained path to 2%. Yes, inflation is falling, but it's not quite at 2% yet. And the reason for that is because if we have a look at the consumer price index measure on inflation, it has been hovering above 3% for quite some time now. And we may see it tick up a little bit again. Actually, it ticked up a little bit in December to 3.4%. It's probably going to stay unchanged there in January. So from the Fed's perspective, their job isn't done. Now, of course, if we have a look at the PCE measure, that's been somewhat more encouraging. But nevertheless, because of the fact that the labor market is so strong, the US economy is so strong, any other indicators out there that's going to sort of underscore that picture. For example, we've got retail sales coming up as well as some industrial production numbers too. So overall, if the data doesn't really give us any indication that the U.S. economy is seeing signs of stress, then the Fed is going to maintain its stance of higher for longer. However, should we see any downside surprises in this CPI, because we've had this pretty significant repricing, we may see quite a bit of a reversal in the US dollar. So the dollar really jumped on the back of the strong data. So any downside surprises in the CPI numbers, we could see the dollar come under pressure.
Let's cross into the United Kingdom now. We'll also be getting CPI data as well as GDP report. Of course, Bank of England officials have been pushing back against rate cuts, but could the data this week justify their stance?
So the Bank of England, yes, they've had some good news in terms of the progress in inflation towards the end of last year, in terms of the economy doing a little bit better than expected. But overall, it is in a tricky spot because, yes, the economy isn't doing as badly as feared, but neither is it doing that great either. And inflation, yes, it has come down quite a bit, but now we're seeing a little bit of an uptick. We saw headline CPI rise to 4%. It may actually rise again to 4.2% in January. Now, we also, of course, yes, you mentioned the GDP numbers there. We're going to have to see whether or not the UK economy did manage to avoid recession, because it did contract by 0.1% in the third quarter. So the fourth quarter is probably going to be flat, maybe a 0.1% growth at best. So overall, though, the picture is one of a stagnant economy. But the Bank of England doesn't really have much of a choice. They will push back on rate cut expectations. But of course, the other important aspect in all this is the labor market. That data out on Tuesday is going to be important in terms of, particularly when it comes to wage growth, because we are now seeing the wage pressures kind of come down a bit. We're going to have to see more of that to basically allow the Bank of England to cut rates at some point later in the year.
And finally, Rafi, let's turn to Japan. GDP data for quarter 4 is out on Thursday. What could the data mean for the yen?
So the yen, of course, has suffered a bit of a setback because the inflation picture has started to turn again. So now we've got a little bit of doubt whether or not the Bank of Japan will be able to hike rates at all this year. Now, the GDP numbers might not have an immediate strong reaction, but they will be crucial to the sort of bigger picture as far as the Japanese economy is concerned. We had seen quite a big contraction in the third quarter, probably we're going to see a bit of a rebound in the final 3 months of 2023, mainly on the back of stronger exports, because consumption in Japan has kind of been subdued lately. Any surprises, of course, would be positive for the yen. But the other important thing about the economy doing better is because of the fact that should the Bank of Japan decide to hike rates, that this decision will be based on its forecasts rather than actual data. So as if there's some doubts about whether or not 2% sustained inflation is achievable in Japan, if at least there's a bit of a positive economic backdrop there, that would support the BOJ's forecast. So I think this may help. If we do see decent growth in the fourth quarter, this may help the BOJ edge closer to exiting negative interest rates.
Rafi, thanks so much. This was The Week Ahead here at xm.com.